All right. Welcome everyone. This is like special episode of Capital Mindset with like a hangout on the Discord call. So we'll see how long this is, but I'll be answering like questions and going over like maybe some live analysis. I'll reiterate some of the analysis I've been doing or thinking about. But yeah, go ahead, ask your question.
All right. So this one actually was feedback on bacon memes. This is part two, Electric Boogaloo. Uh, it's funny that I actually missed this one because this is like one of my quirks. So Fabio, for you, when it comes to entering or choosing to stay or exit a position, where does corporate governance and management teams like rank
Oh, that's
in the
pretty
decision
high.
making?
Yeah, that's pretty high
Yeah.
because because you're when you're investing in any company that you don't have operational control over, you're trusting managers. So it's kind of like remember, I think I've made videos about this or spoken about it, at least in live streams, but definitely I think in a video. And I think it was particular to Intel back when I would exit Intel, right? When I first exited Intel, and I think it was like Austin was still on the show. The reasoning we stated in the video was, well, I disagreed with what management's plan was. And that's all part of governance. So if I don't agree with your plan to move my money, then I don't want to be a part of it. And so that's pretty much top of mind. If I'm investing in a company, I more than likely am kind of signaling, unless there are some investments that I will admit that get less thought than others. That's a consequence of, how many positions I have. And obviously not all positions are as material as others. So you can make the argument, if you look at my portfolio and like the really small positions, it stands to reason that I don't keep up to date 100% of everything that happens. I say that, and I also try to avoid doing that even with my larger positions where I'm like over analyzing. And I think Joel Greenblatt actually talks about this problem. He talked about it very recently in a podcast, by the way.
Ooh, what was the episode? Do you know?
No, I don't recall it, but if you look it up on YouTube, you can probably find a video, most recent video with Joel Greenblatt, and it has no moving image. It's just his voice. And he's talking, what part of the things he talked about in this podcast, which is like, I listen to those podcasts not because they're revealing like secrets. Usually all those times when you're listening to like a super investor is they're giving just like philosophical lessons on investing that you can kind of choose to learn from, but like truly absorb it and then try to kind of learn a lesson that you might be able to avoid yourself doing, because you'll learn it eventually, but hopefully you learn it eventually. But maybe you can learn it without actually experiencing it. So one thing he talks about is in this age of information, the churn rate of investments has never been shorter. And he has partly to blame because information is so readily available on stocks that it causes the investors to be very flinchy with their positions. So something comes out and it's looks like really bad news, boom, I'm out. And I get the information the day of, right, that it happens. While maybe in the past, it could take a little bit before I realize it. And then maybe by the time I get it, there's kind of like a calmness that can, let's say, take over maybe. Or maybe I never get that piece of information. But point being, in the age of information that we're in, and I think it's only going to get better and better and better in terms of how quickly we can get information, that it kind of almost makes sense. People's lifespan of investing, positions lifespan within one's portfolio have shrunk quite drastically, which is bad, especially if you also ascribe to the coffee can approach of investing, that philosophy of not playing too much with the soap. So I try to avoid obsessing over the stock. So like I say, regularly, that there are days I don't even open up the portfolio and I kind of just come on here, the community, and I see what's going on, but through you guys, not because I opened up my portfolio and looked. And I focus on like my day, like what's going on in my day. But yeah, there is a question that came in here and I'll get to that as soon as I include the thought on management, though. So I think that management is one of the more important bullet points. So if I disagree with what management's doing, I want out. I don't want any part of it.
Mm.
Um, s-
Now,
mhm.
I have some follow-ups, but I'll defer to your train of thought and then the question that was in the text.
Okay, we'll do the question in the text and then we'll go to your follow-up. So the follow-up question here. Oh, anyone joining, by the way, this is a recorded special episode Q&A stuff. Thoughts on the pros and cons of what to look out for on skilled nursing home REITs, for example, CTRE and Welltower. So the thing with those guys, it's pretty much a lot of it's going to be the same, right? There's going to be a lot of overlap. So leverage, you want to do like a comparative analysis of leverage. How leveraged are those players to, their respective counterparts or competitors? Because REITs, for the most part, they're within that sector. It's the land itself, aside from the location aspect. There's kind of an aspect of like commoditization in real estate. Like there's low barrier to entry. The barrier is only where the location is. So that's more of like a qualitative analysis. You might want to do that as well. Not you might, you should want to do that as well. And then yeah, the leverage component. You want to also take a look at historically, kind of as a grade for management team, how well have they done in terms of allocation of capital. So kind of try to figure out a way, because every company will present it maybe a little bit differently. In their financials, you can kind of get an idea of, well, what they acquired properties for, and then over the standpoint, that time period, you're trying to find the number, by the way. I think it's property turnover. So you can figure out how long do they keep a property on average. And if a company has low property turnover, it can be a sign that they're making really good investments, because why would you sell the property if it's doing so well? So REITs with high turnover tend to have poor capital allocation. REITs with low turnover tend to have strong capital allocation. Realty income has a turnover rate of, I think it's like 2%, which is really low. And then there's some REITs that are lower, and then many REITs that are higher than that, because that's kind of on the good side of the spectrum. So nursing home REITs have been overbuilt. That's the consensus. And if you go back and watch videos in like 2015 of like REIT conferences or real estate conferences, you'll find a lot of videos of these real estate experts talking to a panel, and they're saying the one asset class or the one type of real estate I'd be buying is nursing homes or skilled nursing facilities. And it was like really common. And I remember when I was investing back in those days, hearing that a lot. And the thesis was simple. It's like aging population, all that. But there's one problem. It's like, okay, but everyone knows that, right? So then what probably is happening is a lot of and this is hindsight now, but and I have, avoided it, but not really for those reasons. But it's a good lesson anyway. So everyone knows that nursing homes is going to be this great investment. So what is everyone doing? Oh, we're all going to be building. We're all going to be just building nursing homes because they're going to be a great investment because of the aging population. So fast forward to today, we've overbuilt, and then kind of the market for nursing homes and skilled nursing facilities has to swing back in the other direction. Kind of what we were just talking about earlier. That's probably going to happen for some other asset classes. And there too says aging population is broke. Then there's also that part, which is more so on the tenant side, because you have the tenants, the operators that are you're paying your rent, and they have to have a sustainable business model. So that there are certain REITs in that space that are exposed to tenants that are themselves really exposed to government spending, and then there are those that are not. I believe and this could be incorrect, but if I remember correctly, the ones that are exposed to the tenants that are exposed to, and stop me if that doesn't make sense, this train. So I'll say it one more time. The REITs that are exposed to tenants that are then exposed to government spending on a big way are the least attractive ones. And those should be relatively easy to find that information. Again, in this age, like you can probably find it honestly in like Seeking Off articles. Authors probably gonna mention it here and there if you want like a quicker way of figuring that out. Maybe, actually, maybe not. But definitely on their 10K, there should be like a risk, and they'll mention it. Their kids can't afford homes and are living at home. Kids living at home take care of their 8-year-old parents who need nursing homes too. All right. Oh, and so Bacon, what's your follow-up question?
I actually want to squeeze this in like a side thing because for the listeners behind the scenes, right now we're recording just before midnight on Tuesday, May the 2nd. So Fabio, just squeezing this one in flavor. What is the best day to enjoy a taco?
Tuesday.
Oh, okay, you're a Taco Tuesday guy. Okay.
There's no other day. Yeah.
Well, I mean, like, there's alliteration for Taco Thursday being a slight contender.
It's not even
Taco
close.
Friday, like in theory, I can kind of see how it makes sense. And then tacos are just so beautiful that you could enjoy them any or every day. And I can see the logic and argument behind that also.
You're making me want to make tacos because people don't know this, but I've recently gotten a culinary spark of excitement, so I'm having fun cooking.
Shout out Carnitas. Okay, all right. So back to serious stuff.
We need.
What's that?
No, I said we need jokes here and there. This is
Okay.
it keeps us, attentive.
Human.
Soft shell.
Okay.
Crispy.
Softball.
Yeah, crispy is that's an American thing. The soft one is the OG. That's the actual tacos.
For sure. Okay, so when it comes to management teams and corporate governance, what would you say would be your useful go-to tools in like taking a look at these teams?
So really, it's there. Okay, so there are actual tools out there that help with this, like databases that you can pay for. But for like a retail investor, there's going to be a lot of just kind of qualitative analysis on a person. You start with Google, right? Usually these CEOs have backgrounds that they list. And then you can kind of almost go the name of manager and then follow it up by lawsuit.
Oh.
Yeah, simple stuff that can yield results. So you can find out. So there was a company, I still haven't posted this video. I have the video on the archive, and I'll share with you guys basically like the contents of it. Because the reason why I haven't shared it is I overtly call this company a fraud, and they are a fraud, and I maintain that belief. And you see why I can't post the video, because I'm saying these things. And the CEO is extremely litigious, and I'm happy to now look up the stock price and find out that it is insanely depreciated. Not insanely depreciated, but it's down like 60 or 70% from when we filmed the video originally. This stock in particular was actually promoted by one of our favorite stock YouTubers, but point being, this person who, the CEO, had a nice little paper trail where it took just one simple Google search, and we're talking about a nano cap, okay? So before you guys didn't guess either of them. Before you kind of say, well, nano caps have very little information about it. That's true. But, Googling the CEO quickly yielded the following results: that the person was arrested before for fraud. And it's funny because I got to find my Seeking Alpha comment on the forums of this particular stock, where I told someone, another, person on the internet, fellow internet traveler. This was before I made videos, by the way. hey, like there's fraud here, like legitimate fraud, and these are the reasons. And then the person only responded, which was the most hilarious response, was the only reason why I'm even mentioning this, was he's a changed man. And I was like, that's not even like a counterpoint, but okay, you're just like gonna buy the stock because it has a high dividend, which it did. He milked the company dry by paying a dividend. They're not even profitable, which is the funniest part. And he owns so much of the company that you couldn't short it. So before you think like, well, why didn't you short it if you know it's fraud? Well, he's really intelligent in the fact that he owns so much of it, and the float was so small. And you might be saying, well, how is it a fraud? He owns so much of it. He used the company to buy his own privately held company. He took on debt in that company. Oh, and by the way, again, when this was filmed, this was like 2021. 2022, he gets investigated by the SEC. Investigation is still pending. He has not gotten away with this yet. But it was so overtly fraud. So all this to say is like it can all start with, like a simple Google search. Like you don't need a fancy database, which again, they exist. And depending on where you're working, you might get access to certain databases, but yeah, they exist, but nothing that I don't think you can they're more like quality of life improvements. They're not really necessities.
Yeah.
So I don't know if that answered your question in full. So
No, it does. And also I'll throw in my own, like, LinkedIn, like can be kind of helpful in seeing the paper trail of if you got someone with real working experience or not. It's funny because remember the company you're talking about.
You know which company it is.
Yeah. Oh, yeah. We've talked about this one in the past, and it's funny like how no, there's still more management stuff. Like I wanted to mention some topical stuff, but right now I'm torn between that and more management talk.
No, ask away.
Okay, all right. Well, topical, I guess. Did you see what Hindenburg said about Icon's fund?
Yes, I took a quick glance at it today, but I didn't go in depth. So pretty much, one of the arguments or one of the criticisms was the dividend that just is maintained at $8 flat forever, and that's not sustainable.
Yeah.
What were some of the other nitty gritty parts? Because for some reason I can't recall.
Basically, it was the accusation of quote Ponzi-like behavior of taking new investors to fund that dividend, essentially. But part of me thinks also that like we've talked about this jokingly in the past of someone like trying to buy out Carl Icahn's fund. And we all knew that the man owns so much of it that trying to short it almost doesn't even matter longer term. Like, I don't know. I could eat my words easily, but like it's not tenable, I don't think.
I mean, they're structured. Yeah, they're an LP. Oh yeah, they have been pretty dilutive actually.
Yeah.
Interesting. I mean, how much have they really cashed out? I'm talking about the Icon family. Wow, they've diluted about 200-ish%. Yeah, that's pretty okay. So there's maybe a point there. I love this guy already immediately comes on and says, I'm in pursuit of income with this 15.7% yield. Yeah, if you want income and you want an LP, go for like the pipelines, man. Because this wasn't part of your question, but this is like part of anyone who's kind of newer and maybe not tax advice, but kind of understanding the difference between an LP and like a C corp. LP, when you receive dividends, the return of capital, for the most part. It's more complicated than that, but simple bird's eye view. Return of capital reduces your cost basis. You don't have to pay tax on it until your cost basis is reduced to zero, and then it's taxed at ordinary income. So yeah, it's some people don't like it because a K1 is more complicated tax form that you're gonna have to deal with, and so some people avoid LPs altogether just because of that reason. But I see that. Oh, I'll share my screen with you guys on Discord too, by the way, because I realized I wasn't doing that. So you guys were like
It,
in the blind, basically.
it's funny. Part of me, like on the inside, like did a little fist pump because I was thinking it's an LP. I think it's a K1 tax form, but anyways, it's like I'm improving on investing. Anyways, so okay, back to management teams. What would you say was like the right amount of board members? Like, can a board be too big? Can a board be too small? Are independent directors really that important or not?
Independent directors, I think, are important. Boards can be too big, yes, because remember, we compensate each of the board members. They are not doing it for free. They're not doing it out of the goodness of their heart. They want monies, right? So I think that there needs to be. We want a board that, on a high level, we want a board that's independent, and that's I think really lost today, unfortunately, with everything that's kind of, I guess, transformed in the public markets world. That kind of relates back to governance because if you don't have an independent board, then you don't have, well, there's caveats to it, right?
Mm-hmm.
I think in the business world, there's no answer that one size fits all thing. And I think that performance of a business longer term will come from finding a business that has good governance, which comes also from the board of directors. But then also, that judgment still kind of passes on and making sure that if you find a great CEO, that the board's also not getting in their way. So kind of thinking about owner or founder led companies, right? So founder led companies, why some super investors really prefer to find those guys is because those companies are going to be treated and run or ran as if they are the child of that person who started that company. So your interests are aligned. And so if you want a board, if you're kind of looking at the board and you're of that, if you ascribe to that philosophy, you kind of want to make sure that the board isn't getting in the way of that person that you're betting behind. But then again, you'll find other instances where you're kind of shrugging your shoulders and saying, why isn't the board stopping this crazy maniac from doing these things and removing them already because they're clearly not acting in line with shareholders, or the board of directors is setting up these crazy compensation packages that make no sense. And so that's kind of a judgment you'll make, but I feel like that's more of the individual judgment you should make, not do they have independent directors, non-independent directors, etc. I think that, looking at compensation packages speaks louder and kind of will tell you if board's on your side or the board is not on your side. Rather than, kind of more of a title of, oh, I'm independent. But then,
Okay.
like I feel like compensation packages are a good way to gauge that.
Mhm. What are your thoughts on C-suite, especially CEO, having a board seat or seat on specific committees, like the common board committees?
I feel like in aggregate, it's probably an issue, but there's going to be plenty of examples. Again, that's still like a judgment call we make. So if you don't like it, don't invest in it.
Yep.
But I feel like there's plenty of companies out there where if we see that that CEO is also the chairman, it's probably fine because again, looking at what they do, I think you can just look at their actions to kind of gauge whether or not that's an issue. One of the most, I guess, loudest actions is look at how they're setting up compensation packages because money is what talks in this world. So if you look at the compensation package, that's the money talking, and the money is telling you, well, are they set up in a way where they have to work for you, or are they gonna win no matter what, and then therefore they're gonna be like, I don't really have to like do good by my shareholders. It's fine. I'll let that slip. So yeah, that's kind of where I'm going. So basically, back to I'd focus more on just how are the comp packages looking.
All right. I guess one of the weird questions that I have is like a weird off the top of the head curveball is when it comes to picking a company. and we have our managers, we have our board. At what point should we forgive? Like, say for example, company has their projections, they have their numbers, listed out last quarter, and then they have a relatively disappointing earnings, or they come out in the middle of the quarter and say, yep, we got to modify our projections. What do you do then?
So that judgment is almost every answer is like, oh, it's individual by individual basis. But no, okay. So broadly speaking, I mean, I think like let's separate situations where it was in their control and out of their control, and then let's unpack both of those. So I think a situation where it's like in your control is going to be more closely in line with like margins. So for example, you didn't control your costs. Well, what were you doing? Were you not paying attention to your supply chain, right? Were you not, appropriately allocating or negotiating for prices on your products up your supply chain, right? Or your resources up your supply chain to get to your end product. So those are things that could have been probably mitigated. Something where it's like, let's take Thor Industries. Where Thor Industries, I'm using an extreme example of cyclicality. Is it their fault that RV sales are down 50% in December? I don't think so. And let's say they thought it was going to go down 40% or 45% and went down 50%. Is that necessarily their fault? Will I be super angry with management because they missed the mark on that? No, I probably won't. But let's say they had costs that just suddenly skyrocket and they're unable to mitigate those effects, and that margin falls. I don't know. I'm making up numbers here because I don't have the margins in front of me, but let's say like 500 basis points difference in gross margins. Then I start to ask questions like, okay, well, why did that happen? Maybe they're probably going to give an explanation. Analysts are definitely going to catch that and say, well, what's going on here? If they didn't already explain it. And if they did explain it, usually there are going to be follow-up questions to dig a little bit more into that. And then you kind of see, okay, well, is that reasonable? Is that acceptable? And that's, that individual basis comes in. But for the most part, on a high level, I separate things that they can control and things that they can't control. And kind of going from there, if it's in their control, then I start to make, different judgments of them. If it's out of their control, maybe it's a judgment call on like, do I even want to be involved with that sector, right? Is that sector maybe a bad sector? And so they have a good management team, but it's a terrible business and a terrible sector. It could be that. So that could be the answer to my question, and if I go down that road. But yeah, did that answer your question?
I think so. I think so. And then of course, like, asking your perspective, like, doesn't really make a right or wrong answer, I don't think. I mean, because I imagine you're not lying.
Yeah.
Yeah.
No.
Yeah. No, because like I was thinking, like, anecdotally, you mentioned supply chain mess ups, and one of the dollar stores, like right around COVID, said, "Oh yeah, our supply chain's fine," and then market disagreed, and the results showed he was wrong, or the CEO was wrong, but they pivoted and they rebounded within a couple quarters or so. So it could be one of those things where there's opportunity, one of those things where some forgiveness or patience is, maybe warranted, case by case. But yeah. Anyways, yeah, I think that was like, I think management and corporate governance was like the one thing I got hammered on, was like asking about your decision making and thought process. So I don't want to monopolize the Q&A. There's plenty of brilliant people in here. And with that, I will transition myself out, throw myself under the bus, and someone else can take over.
All right.
Thank you, Fabio.
Yeah, no worries. That's what this is all for. So in kind of like that filler between questions, I'll kind of reiterate the analysis for the purpose of the recording. I don't know if this recording will make it to YouTube or just strictly like a unlisted video for CM members and Sense members. So I think I'm leaning on maybe this one's going to be public for now. That's where I'm leaning. If I
Yeah.
feel like there's, yeah, so, it'd be nice just to give it to the people. But this is recorded. So if you guys are, sleepy, want to go to bed, don't worry, you'll be able to see all this. But yeah, so I began the recording, or prior to deciding to record this, because this is, for anyone watching this recording, this is what we do at nighttime. I'm going to be doing more of this. It's kind of like nighttime hangouts. I don't talk this formally usually, but because it's recorded, I'm very formal in my language. But to kind of get started and discussing how I was, on here and just doing my nighttime research, particularly focused on real estate, and then some companies that reported earnings today, such as Murphy's USA, Zebra Technologies. Hold on, there's someone who gave me, this is a SoFi comment. Well, yeah, that's all about that. So, yeah, the point of, or what I wanted to get across with real estate right now is I think that there's going to be like a transition in places like, let's keep it to the theme, office, and some conversations I was having today, how there's seemingly in the pipeline a lot of private players and even public players that are considering transitioning these properties from office to residential. And it's already kind of been in the works in some cases, depending on what market you're in at different scales. And that's kind of interesting for the prospects of supply down the road in like 3 years, because that's how long it will take. So cutting to the chase, I think that office REITs are going to continue to have more pain, and they're officially at a lower valuation than around 2008, which is interesting. Not on an absolute price basis, but although we're not too far away from that. And I stick by my guns in terms of saying that Class A is going to be the best way to play that and the most lucrative. Very dangerous way to play it is going to be in that Class B section. But all in all, the trends look promising. If we follow Europe in this, we're going to get back to levels at some point. Looking at earnings reports that came out recently, the most recent ones for office REITs, the Class A players had a common theme of witnessing or observing and measuring higher returns to office. So that's promising, because United States has lagged Europe, and kind of getting into that, or back to that point that I was making earlier, how there's a lot of players that are converting. That's not going to be seen in the market for a while. So just like how even in 2008, it took a couple years for that sector to recover, I think this is going to be kind of a repeat of that in terms of how long it's going to take. So it could take several years. And so finalizing that point, you can afford to be quite patient with these names. I just don't know for certain if it'll take 3 years, 2 years, 1 year. I really don't know the answer to that, but I have a feeling it's going to take, a good amount of time. Now, I also want to say that for those of you who are CM Gold and Sense, you guys know that I provided actually the update to the portfolio update. You guys can check it out there. And you can see that I've raised a decent amount of cash. So that is to say, I did the calculation earlier. It's around 30-ish%. So I'm about 30% cash, and that was raised in the span of 2 days. So yesterday and today. And I done so, or attempted to do so, in a tax neutral basis. And then in my personal holdings, attempting to do the same. What I mean by that is I'm trying to, this was more successful in my personal holdings than in the holding company, because the holding company just doesn't have as many positions. So looking across the portfolio, what positions are, let's say, looking first at the losers and saying, okay, can I tax loss harvest this out? And then looking at some of my winners that maybe I don't have as much conviction in, or I don't really, or are not material, and say, okay, do I really feel like this belongs here in the portfolio at this time? And then I can, negate that with the loss I recognize in the other position. So I try to do as much of that as possible. And then, of course, some gains have to be recognized. I can't avoid that forever. And it's just, first trying to be as efficient as humanly possible. But, we're not going to be able to master it or be perfect. Now, what I'm going to be doing with that cash is yet to be seen, but I will say that for the holding company, you guys, I guess, will be kind of awaiting. I'm also waiting because I don't want to make it sound like I know what I'm going to be buying. I have the third largest position in that portfolio, reported earnings today, and volume after hours was too small or too low to kind of gauge the actual results or how the market felt about those results. My opinion on the results, looking into it off the bat, was I thought it was good. The company I'm talking about, for those watching on YouTube, is Murphy's USA. So Musa, I'll pull it up here. So we're going to be listening to the call when that's out. I'm listening to the recording. I'm not going to listen to it live. But they also approved another 1.5 billion stock buyback program. So this is after the completion of its current $1 billion buyback program. So that's the I guess the new buzz that we can kind of talk about. But the story with Musa is quite simple. It's going to be a buyback story, a cannibal of sorts, and I think there's a decent amount of community members that not a lot. I think there's actually good debate, really good, healthy debate for this company. And then some other reports today, we also talked about, or I mentioned Zebra Technologies, which is one I was taking a look at. And I want to just say that upon initial glance or analysis, I'm determining that Zebra is kind of hitting now that fair value territory, where once I normalize the growth rates, kind of bringing it back down to historical levels, removing the anomalies of 2022, 2021, we've pretty much hit like fair value for Zebra, my opinion. Now, I'm not buying Zebra, so that's probably my that's probably me saying how I'm not biased. So I have not done enough research to determine really if I wanted to buy or not buy it, but I just took a peek at their earnings, and market didn't like it. It's down 11%. Concerned more mainly on it's always guidance. It's always guidance. Guidance is always the issue. So it's not just about current performance, but it's about what the analysts, what the market thinks that's going to happen to the company in the near term. Okay, so getting into some more bird's eye view outlook on the economy. So we are now in backwardation for oil markets. So oil markets are now basically, so we talked about oil markets being in contango up until like the June contracts. Well, we're now, the next month is June. Now we're seeing backwardation. So simply meaning the price in the futures now, decreasing. And that is concerning for oil company profits. So that is actually something I'm taking into consideration. I haven't made a decision on that for my Occidental Petroleum position. But I'm taking that into consideration as far as my aggression. Thankfully, Occidental Petroleum is really small. And so if I come to that conclusion that maybe I need to, sell it, but I don't think that's going to be the conclusion. I think my conclusion is going to be more so along the lines of, okay, good, I didn't allocate too much, and maybe the market now is going to present to me a very good or interesting opportunity to acquire shares at a much lower price. Because market is now reaffirming its belief that oil prices in the future, near-term future, are going to decline. And if you've watched Capital Mindset videos for quite some time now, the market we already have two markets that are kind of in line with each other, which was the oil markets and bond markets. There was something on the horizon, unknown, that could cause demand destruction. Both were saying it in different ways. So yield curve inversion, classic indicator that Fed or experts I use air quotes, experts, because there are experts that respect it wholly, and then there's experts that respect it sometimes and then disrespect it other times when it doesn't fit their narrative. And I'm talking about the ones that you listen to that will say yield curve is outdated and all that jazz. Well, because if we don't have something going on, and I think it will be like the first time ever that we had an inversion for this period of time, a sustained inversion and a deep inversion for this period of time, and nothing happens. This will be the first time. And maybe you're living through history, that's possible. But I'm going to kind of err on the side of caution and say, no, it's not. It's going to rhyme, and we don't know what causes it. And remember last year we were talking about, or I made many videos about liquidity crunch. I had no idea we would have bank failures ever. I didn't think that. So if I did, I would have shorted, banks, right? But I didn't think that. So I didn't have positioning to gain that exposure or to profit from that exposure. Last year, while I understood that there was a liquidity crunch occurring and I was able to profit from that, I was not able to identify a profit because I think that's nearly impossible to identify the event. I mean, no, it's possible. I think I definitely didn't have time, I think, at the time to find it. I would have had to been hunting inside of bank balance sheets to find, okay, well, we have a liquidity issue, because there were some analysts that were pointing that out. So I don't want to say it was not possible. But what I'm concerned with now is that both markets kind of in agreement. Well, they've been in agreement for a while, but just taking some precautions and seeing how, well, we saw FRC die. Now the market's concerned about these other banks. I don't think all of them are going to die. I legitimately do think there's like diamonds in there somewhere. But we were talking about before the camera turned on, how investing in banks is exactly like a black box. Like you have actually no idea. And one of the subscribers was talking or mentioning some of the words from Carlyle, where he was using an anecdotal experience of talking to bank experts that told him, well, we're really good at analyzing banks and all that, and even they will miss things, and because banks are essentially a black box, so they're just very difficult to really gauge what's going on. And so it's not what you find that will hurt you, it's what you don't find that will hurt you. So that being said, I guess black swan event that we were waiting for, that the bond market was waiting for, is perhaps started. And I maintain my point from the live streams. Consider this kind of like an impromptu live stream of sorts, but not really, because not really a live stream, traditional live stream, but that we are going to see credit crunch, right? And I don't mean liquidity crunch like from the banking now. I'm talking about credit crunch from consumer side, consumer lending. And I think that for the most part, we're seeing, well, I mean, you're having like warehousing is costing them a lot of money. Yeah, because right now the spreads are pretty messed up in some markets. But anyways, kind of focusing mainly on the point at hand, I think that banks in general, they're kind of that trigger point, and it's going to trickle into the rest of the economy at some point later this year. So that concern right now is the market is concerned about the spillover effect into or what's going to happen now with CREs, commercial real estate. So commercial real estate, if you're a bank with any form of exposure to commercial real estate, it's not just now about liquidity, it's also about credit risk. So credit risk is now being reintroduced into the market. So now you have a double whammy. Do you have liquidity issues and credit risk? And things could get kind of testy. Now, I think it's in the bag that the Federal Reserve will emotionally try to affect the market. You know how I feel about that. And they will lower rates. I think they already were destined to do so. So the bond market will be proven right yet again. And the Fed is not a leader, but a follower. And yet again, they will do as they are commanded. No, not as they're commanded, but basically as a form of circumstance, they must do. They're not really, let's say, as powerful as they want others to believe they are. So interest rates coming back down longer term is definitely in the cards. We are heading in that direction. Now, I know that the Fed's reporting tomorrow, or it's going to announce tomorrow what they're going to do. I know I've been saying this for a little bit now, but I still don't really care what they say tomorrow. I think it's written in stone at this point that they're at some point in this year or next year they will be bringing rates down fast, and I bet you they're going to fall. Let's have that game. So, there's not actual wager here, but like a friendly wager with anyone who wants to take the other side. You could just comment down below or something, or just remind me. And I think that when rates get cut, they're going to get cut hard, as in we're going to move a lot faster. We're going to do the elevator down versus the escalator up. So that's what I mean by that. But yeah. So I don't know what I'm going to be doing with that capital. I'm going to be hunting, just like all of you are constantly hunting in this community, which is great. And hopefully I find a home for that capital. But I'm in no rush to really find a home for that capital. Again, my returns for, and since this is going to be on YouTube, I will not show the dollar figures, but let me pull up the yearly returns. Not the year to date, because this is the point I'm going to make.
If it's cash, there are tools for short-term liquidity with some returns.
Are you going to suggest that I put it into CDs? Brokered CDs?
I am just saying, have you heard of the story, the tragedy of Darth Plagueis the Wise, Fabio?
Yeah, you just say put options. Just say selling put options. Alright, just do that. No. Do it.
Yeah, just pair trade a SPY and VIX or some sort of choices around there. No, definitely not financial advice. But I'm just curious, what sort of wager are you trying to bait the macro tourists in this Discord and YouTube?
Oh no, it's just a friendly wager. So I'm trying to I'm setting this up so it doesn't
Yeah.
So this is what it's looking like right now. So this is the portfolio that the members see in terms of its position. So that's the returns year to date, and this is not my personal holdings. This is the holding company that you're seeing. And so year to date, you can see it's well, that's the NASDAQ. Let's switch that to,
Yeah, we only see Musa.
Well, Fook, the holding company was revealed to YouTube.
Yeah,
the dollar figures.
It's just like how you misuse M1 finance. There goes the moving bus.
All right. Well, I'm too lazy to edit that in there. So now, YouTube knows a rough number of the holding company. I'm going to be a lot more careful with the personal holdings when I bring that up. But yeah. So the holding company is this portfolio that I created for the purpose of just creating basically a new portfolio and new positions and all that. I've explained it time and time again. But let me switch it to another index. That is unfortunate that it does that. Oh, well, there goes. It's whatever.
I don't know. Maybe Discord or my Discord's messing up, but I only see Seeking Alpha's webpage on Musa.
Oh, you know what's happening? That's funny. I have Discord shared to not screen. Let me redo this.
Yeah, see, Fabio, you didn't do anything wrong. Yeah,
No,
yeah.
no, 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 because OBS captures the full thing. So no, OBS definitely caught that.
Oh, oh, and OBS is going to get uploaded to YouTube.
Yeah, yeah. OBS definitely
Oh,
caught that. Unless I cut it out if I really want to put the effort and cut it out, but yeah. So yeah, that's the S&P. Dang it, it didn't switch to the S&P. I literally had it on the S&P and it didn't do it. So I was in NASDAQ, S&P total return, and I have to click. Oh, okay, that's annoying. I have to click apply, and then as soon as I click out of it, it doesn't do it.
Did you sell all your REITs? You fucking clown.
So no, I didn't sell all my REITs, only in the holding company, because I'm keeping the REITs in the retirement account.
I love that.
Oh, okay. Okay.
Yeah.
I refrained what I said. I refrained what I said.
So there, that's compared to the S&P. So the Nasdaq has done really well year to date, but what I'm trying to just say is like I'm in no rush to find a new investment. Right now, I'm pretty, I guess, relaxed with where things are at, and then I'm happy to hold that cash and just hunt patiently.
I just find it funny that this podcast ended up getting scuffed.
Yeah, no, it's kind of funny, but all right, let me go to the. I'm gonna be much more careful with this one, but year to date, I think this one is much more muted actually, because this one now includes like some positions that have lagged a little bit more, and so this is across all accounts. So the year to date on this one, because the positions that are lagging is just this. So it's not that impressive. 10.49%, because concentration on some other legacy positions that just haven't moved.
Wait a minute. So what you're saying is, and if you're playing bingo at home, there's an element of timing luck?
Well, precisely. So like the positions that are more concentrated in the holding company have done much more this year. Because now if you look at the longer term return of that portfolio, it's still on a total return basis, it's doubling the market on that. And then on the longer than 3 year, it is a bit almost 3 times the market return on that.
I just think it's funny how members in the broader capital mindset universe have their own catchphrases.
Woo! Musa! Woo!
Who is that? Oh,
That's Zeratorn or Brian.
Brian, just so you're aware, by the way, this is a recorded session.
Nice.
No, just fair warning to anyone. It's not because like, oh, you can't do anything. No, you guys can do whatever you want. But
Yeah.
I'm
Yeah,
trying to money growing.
So, it's a recording. Don't say anything offensive, okay?
oh yeah, you guys can hear. Broader YouTube can hear Unfiltered Kingdom.
Yep. Kingdom's catchphrases is it's trash.
All right, so that's pretty much covering all the topics of today. If there are any follow-up questions, otherwise we'll close it off here and end it.
I guess. All right. So if tacos are for Tuesdays only, what about tortas? Torta Thursday?
Sure.
Does Thursday get its day?
Thursday can have tortas.
Okay, so the alliteration is really that important.
Yeah. Sam, you can ask almost anything.
For context, it's Kiwi Sam specifically.
Yeah, almost anything can be asked.
There's history.
There are limits. There are limits to the questions that may be asked, but for the most part, yes. I'm not reading that. I'm not reading that out loud. And no, for the second question, I am not saying my social security number.
8675309, even though that's a phone number and a song.
Bacon just somehow guessed my social. Wow, that's creepy. I'm just kidding. All right.
No, that's
no, I got you. with that being said, guys, thank you guys so much for listening in. I don't know if you're going to be watching this on YouTube or I end up making this kind of a more community exclusive video. However way, hope you guys enjoy it, whoever watches. And I will see you guys on the next one. Bye.
Do 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 do.